Want to know why Asia stocks are rising and which markets stand to benefit? It starts with oil prices sliding as Middle East tensions ease, and that shift is cooling inflation fears. When crude falls, the region breathes easier. Energy is a core input for households and factories, so a cheaper oil basket can quickly improve spending power and corporate margins. That relief changes how investors see inflation and interest rates, and it often nudges money toward risk assets. This week, South Korea led the move higher, and energy-importing economies across Asia followed. The driver is the oil risk premium compressing. Signals of de-escalation took heat out of crude benchmarks, reversing a recent upswing that had tightened financial conditions. With fuel cheaper, headline inflation pressure moderates, especially in import-dependent markets. That softens the case for tighter policy and steadies rate expectations. As policy paths look firmer, equity volatility cools and trading liquidity improves, which supports flows into broad market ETFs. Market leadership is rotating too. Cyclical and rate-sensitive shares are catching a bid as input costs ease and margin visibility improves. You see that in consumer discretionary names, airlines, shippers, chemicals, and parts of industrials. Export-heavy segments in South Korea, from semiconductors to autos, can benefit as operating leverage works in their favor. Energy producers may lag if crude stays subdued, reflecting weaker upstream pricing. The regional context matters. South Korea imports about 93% of its primary energy, so a sudden oil drop directly supports company cost structures and the broader economy. Japan, sourcing roughly 90% of its crude from the Middle East, also gains when regional tension ebbs and fuel prices dip. Both countries target inflation near 2%, which means visible energy relief can accelerate progress toward that goal and anchor central bank guidance. Those anchors translate into quicker pass-through to CPI, earnings revisions, and potentially higher valuation multiples. For investors, the practical takeaway is simple. Treat oil as a barometer for Asia's equity risk appetite and margins. When crude retreats on easing geopolitical risk, watch for rotations into consumer, transportation, and manufacturing, and reassess rate-sensitive exposures. Keep an eye on central bank commentary as inflation impulses fade, and stress test portfolios for both lower oil and mean reversion scenarios. Read the full article at finlitica.com. Quick reminder, this is general information, not financial advice. Your money, your decisions, so always do your own research.